And so I think that the challenging thing is that here in 2025, because we're on a potential trend change, it's potentially a more volatile year for a lot of risk assets. Now, this administration's viewed as favorable toward Bitcoin and crypto, so it's probably regulation surprises are to the upside there. Some of the tariff things, while that can impact liquidity, that's more likely to impact profit margins of companies. So being in assets like gold or Bitcoin can be perceived as protecting investors from any sort of uncertainties there, and they're more kind of putting themselves in the whim of liquidity. So the short answer is I consider the next 2 years probably be moderately good for liquidity, but more bumps than we've had probably since the regional bank crisis of early 2023. So we have more twists and turns ahead, but probably still reasonable for liquidity.
Alden highlights the historical precedent of balance sheet reduction and its effects on liquidity. When the Federal Reserve reduced its balance sheet in the past, it led to liquidity crunches, such as the repo spike, which ultimately forced the Fed to reverse course and reintroduce liquidity into the market. This was notably beneficial for risk assets, including equities and Bitcoin.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Well, so when we saw the balance sheet reduction in the past happen, and the repo spike happened, and they went back to balance sheet increases, that was good for risk assets generally across the board. We only had a multi-month sample of that because eventually in early 2020, COVID hit and we got like liquidity bazooka. But even before then, that period from September into January, February was pretty good for asset prices, and you did have that kind of background QE. Generally speaking, any sort of intentional dollar devaluation or Mar-a-Lago Accord would probably be constructive for risk assets across the board. You could face a little bit of a hangover if you get like a weaker dollar gives you higher inflation, and therefore they price in a more hawkish Fed, but that's kind of a second order thing. Generally speaking, the initial impact is probably pretty good for risk assets. And so I think that the challenging thing is that here in 2025, because we're on a potential trend change, it's potentially a more volatile year for a lot of risk assets. Now, this administration's viewed as favorable toward Bitcoin and crypto, so it's probably regulation surprises are to the upside there. Some of the tariff things, while that can impact liquidity, that's more likely to impact profit margins of companies. So being in assets like gold or Bitcoin can be perceived as protecting investors from any sort of uncertainties there, and they're more kind of putting themselves in the whim of liquidity. When you have a debt ceiling dispute, which we don't know how long it's going to go, historically, they've not really had intra-party disputes that go on very long for the debt ceiling. Usually it's Republicans using it against a Democratic president. We haven't really seen Republicans using it aggressively against a Republican president. So I don't expect the debt ceiling thing to last a long time, but should it could go all the way in the middle of the year and be good for liquidity. But then you'd run into problems in the second half of the year when they try to refill their cash account. So the short answer is I consider the next 2 years probably be moderately good for liquidity, but more bumps than we've had probably since the regional bank crisis of early 2023. So we have more twists and turns ahead, but probably still reasonable for liquidity. Now, when Bitcoin is like sub 2 trillion market cap and quite volatile, there's generally a lot of career risk in some of these proposals. So it takes kind of a pretty forward-looking person to kind of take that risk. So in MicroStrategy, in their case, it was the founder still running the company at the time.
Right.
Now he's chairman, but he was CEO at the time, and so he could kind of run that almost like a small business despite being publicly traded. And it kind of took another cycle to see other corporations hop on board and have clear accounting and see a full cycle of it working really well for MicroStrategy before they started kind of dipping their toe in the water and trying that. In addition, we've seen El Salvador stack Bitcoin on the sovereign level. We've seen Kingdom of Bhutan do it. So these smaller, more kind of unilateral decisions, and then the fact that they worked out becomes non-silly for some of these other entities to at least entertain the notion of saying putting a non-zero amount into Bitcoin. In addition, as a neutral reserve asset that protects seizure, it's also potentially useful for payments. Like when Russia's scrambling to say, okay, well, how are we going to make payments if we're sanctioned, and what ledger can we agree to some other trading partner to use with us? Like a leading open source ledger is like part of the discussion. Now it's probably still too small and volatile, but it's at least entering the picture as, hey, we want to not only secure value, but be able to transfer value to trade partners should we need to. It's more efficient than flying a plane of gold across borders. So I do think it is. And then when the U.S. is giving it cover, when you have, like Trump talking about it and people in his circle talking about it, it reduces the career risk of other countries talking about it. So if anyone is at a corporation or at a government entity and they happen to be bullish on Bitcoin, they have more of a window to say, hey, maybe we should consider this. I still think in this cycle, it'll still be a minority, but around the margins, there's this clearly interest there. And then there's rumors that some more Middle Eastern countries have some reserves that they haven't really disclosed yet. Probably true, but I can't vouch for that. And generally speaking, it's just more incentive for kind of smaller entities to do it, or ones with just more kind of forceful or forward-thinking leaders.
If the U.S. attempts to reverse globalization through reshoring efforts and trade barriers, the potential upside includes higher domestic wages and a revitalized manufacturing sector. However, these policies come with a significant trade-off: inflation. Higher domestic production costs could drive up consumer prices, leading to further economic complications. She highlights an often overlooked factor in this equation: U.S. healthcare costs. The U.S. has the highest per capita healthcare expenditures globally, which places a significant burden on employers. Any meaningful effort to revitalize manufacturing must also address structural inefficiencies in the healthcare system to make domestic production more competitive.
It's interesting because they maintain the world reserve currency in the GOP platform. And him and his Treasury Secretary and his group around him has explicitly said, we want to keep the dollar as the global reserve currency, despite the fact that we want to address the trade balance. Without a lot of talk about that's what's fueling, those are kind of two halves of the same thing. Now, the person in his orbit that probably gets that the most from my reading is Stephen Murin, I believe is his last name. He's been nominated to be his head economic advisor. And he's the one that's done a lot of work on this, saying that some of these policies might be dollar strong initially, but then later dollar weak. Technically, there is a difference between how cyclically strong the dollar is and whether or not it's the global reserve currency. So Trump has talked before about other currencies being unfairly cheap, talking about potentially exchange rate differentials as part of a negotiation, like intentional dollar weakening. And you can have a burst of intentional dollar weakening while still being the global reserve currency. So I think that's probably the trade-off that they're willing to make, which is to risk some inflationary outcomes, potentially do a dollar devaluation once they get some of their initial tariffs and concessions and things like that set up. I do think they'll probably look at the currency differentials. And some of those economists have even talked about trying to disincentivize other countries from holding as many U.S. assets. And kind of boosting up artificially our asset values and our exchange rate. But there's kind of like how there was losers on this past 40-year trajectory. There'd be losers if you just kind of start reversing all that. The losers would become the winners. A lot of the winners would have to change things to stay winners or would be losers. And therefore, you probably have pushback by certain corners of the economy at those policies. And even if you didn't have pushback, just the sheer trend of trying to turn a major trend is hard. And then especially because a lot of people that want this trend change don't necessarily know some of the trade-offs of why those trends are in place and what some of the sacrifices might have to be done to reverse them. If we kind of summarize globalization, the main benefit is that it was disinflationary. So our supply chains got a lot more efficient in a way. Everybody's working together, so there's not that many like frictions in the world. Everything can kind of go to wherever the cheapest thing for that is, which can change over time. But the downside is it pressures U.S. wages, it pressures U.S. kind of manufacturing areas. And if you do want to reverse that, one of the risks is, sure, it could be good for American wages, it could be good for American manufacturing, but it could come with a side dose of inflation. And another thing I kind of point out is that in order to structurally fix U.S. manufacturing, you probably at least have to make a meaningful dent in structurally fixing U.S. healthcare. And that's because the U.S. has by far the highest per capita healthcare costs in the world. And it, generally speaking, that falls on employers to facilitate a lot of that for their employees, which is an expense that you don't have in, say, Japan at a similar level. For even they have an older population, literally less healthcare spending per capita. And so it's not as burdensome. And so one of the risks is they try to fix with a bunch of Band-Aids and you don't actually tackle the core problem. And then you get maybe not as much reshoring as you expected. The reshoring that does happen is kind of expensive because it's kind of forced there from tariffs and hard things, but then it's actually expensive once it's here. And then you get a kind of a bunch of lose-lose situations. I think that that's kind of an extension of fiscal dominance, is to say that basically those that are running fiscal matter a big deal. In addition, they have a variety of other things like tariffs that, while that is technically part of fiscal policy, it touches other parts of the economy as well. And so I still think it's the case that, generally speaking, Fed-related stuff is not like the number one thing. It doesn't mean it's not a variable, but anything kind of monetary related is a little bit in the backseat compared to fiscal. And another way of thinking about this is that we're at a potential pivot point because we've had almost 2 years of fairly similar macro environment, which was Fed's tightening, they're draining liquidity, and the Treasury is putting liquidity back in. They're running very big deficits, but then they've also shortened the average duration of their debt. Or more specifically, it's correct to say that they've issued extra T-bills, which are their most cash-like debt instrument that they have, that has sucked extra money out of the reverse repo facility. It's kind of like taking excess QE from a couple years ago and putting it back into the market while the Fed's doing quantitative tightening. As you've had that kind of offset, I would say that dynamic began in like early 2023, and it's really been in place ever since. And we're getting toward the end of certain trend points, which is to say that there's not much money left in the reverse repo facility. So we might have more of a shakeup between the Treasury and the Fed. And then in addition, we have the executive branch that is obviously newly elected and coming in hot with a bunch of policies that are quite different than the prior administration. So there's certainly a lot more balls up in the air here to juggle as we kind of see what's going to happen.
Alden concludes by discussing the broader theme of fiscal dominance, where fiscal policy, government spending, and taxation exerts a greater influence on markets than monetary policy, Federal Reserve actions. She notes that since early 2023, the U.S. Treasury has been offsetting Federal Reserve tightening through large deficit spending and the issuance of short-term debt instruments like Treasury bills. As the reverse repo facility approaches depletion, a shift in Treasury-Fed dynamics may occur, leading to potential disruptions in liquidity. Additionally, the new administration's aggressive policy stance introduces further uncertainty, increasing the number of variables investors must consider in 2025. Please like and subscribe.